$5.9 trillion. That is what vanished from the precious metals market in exactly 30 minutes this morning. Not 30 days, not 30 hours, 30 minutes. I was watching my screen when it happened. Gold was trading at $5,595 an ounce, the highest price in human history. Then the selling started. Within minutes, gold collapsed to $4,941, a $650 drop. Silver was even worse. It was trading above $120. Then it crashed to $95, a $25 move in the time it takes to make a cup of coffee. Bloomberg called it the biggest single-day decline in 4 decades. The Financial Times said it was a capitulation event. But here is what nobody is talking about. While the West was panic selling, something very different was happening in Shanghai. Chinese silver contracts were trading at $125. That is a $30 premium over the COMEX price. Let me say that again. China was paying $30 more per ounce for silver, while Americans were dumping it. This is not a market correction. This is a market fracture. And if you understand what is really happening, you will see why this crash was not the end of something. It was the beginning. What you're about to learn in the next few minutes will change how you think about precious metals forever. But before I continue, let me ask you something. If this is the kind of analysis you want, why are you not subscribed? I track these movements in real time. I connect the dots that mainstream media refuses to acknowledge. Hit that subscribe button right now, because what comes next is going to move fast. Now let me show you what triggered this crash. At approximately 6:30 in the morning Eastern Time, President Trump announced his pick for Federal Reserve Chairman, Kevin Warsh. The name might not mean much to most people, but to Wall Street, it was a bombshell. Warsh is what they call a hawk. That means he favors higher interest rates. Higher interest rates strengthen the dollar. A stronger dollar is traditionally negative for gold and silver. Within seconds of the announcement, algorithms started selling. Not thousands of contracts, millions. The speed was unprecedented. Robert Gottlieb, former head of JP Morgan's metals desk, said the move was vicious. But here is the part that should concern you. This was not organic selling. This was a coordinated liquidation event. Let me explain. 2 days before this crash, on January 28th, the CME Group raised margin requirements on silver futures from 9% to 11%. That means every trader holding silver contracts suddenly needed 22% more cash to maintain their positions. When they could not come up with the money, the exchange liquidated them automatically. Margin call after margin call after margin call. A cascade of forced selling. This is exactly what happened in 2011 and in 1980. Both times, margin hikes marked the peak of silver rallies. But there is one critical difference now. Stop. I need to be honest with you. What I just showed you is what the headlines will tell you. It is the surface explanation. But there are 3 things happening beneath the surface that will determine where silver goes next. First, the exact timing of the margin hike relative to the Warsh announcement. Was it coordinated? Second, the unprecedented divergence between Shanghai and COMEX prices during the crash. What does China know? Third, which specific institutions were selling while retail investors were buying at the top? These are not things I can fully explain in a single video, but I cover these patterns in depth on this channel. Every development, every connection, every signal. If you want to understand what is really happening, you need to be here. Subscribe now and turn on notifications. The next video could be the most important one yet. Now let me show you why this crash is different from 2011. In 2011, silver crashed because of excessive speculation. Retail traders were using leverage to bet on silver going to $100. When the CME raised margins, they got wiped out. But the underlying demand was not there. Today, the situation is completely different. Today, there's a structural deficit in silver. Global production is around 830 million ounces per year. Global consumption is over 1.2 billion ounces. That is a shortfall of nearly 400 million ounces every year. Where does the extra silver come from? It comes from existing stockpiles. And those stockpiles are disappearing. COMEX registered silver has been falling for months. LBMA vaults in London have been draining. The Shanghai Futures Exchange has reported record low inventories. And on January 1st of this year, China implemented something that changes everything. A silver export licensing system. Only 44 companies are now authorized to export silver from China. Every single shipment requires government approval. China has effectively weaponized its silver supply. Think about that for a moment. The country that consumes the most silver for solar panels and electronics, the country that refines the majority of the world's silver, that country just locked down its supply. And then, on the same day the West had its biggest crash in decades, Shanghai was bidding up the price. This is not a coincidence. This is strategy. The paper market crashed. The physical market did not. In fact, while COMEX silver was plunging, the Perth Mint in Australia stopped accepting new silver orders. Metalor, one of the largest refineries in the world, halted new orders. Argor Heraeus and Nadir reported severe backlogs. No deliveries until April or May. Wholesale premiums spiked 100 to 200% in some markets. This is not the behavior of a market that is collapsing. This is the behavior of a market that is fracturing. The paper price is going one direction, the physical price is going another, and the gap between them is widening every single day. If you have been following this channel, you know I have been warning about this divergence for months. The question is simple. Are you paying attention, or are you going to be surprised again? If you're still here, you understand what is really happening. Subscribe, turn on notifications, because this story is far from over. Now, let me show you what the institutions are actually doing. While retail investors were panic selling this morning, central banks were not. They have been buying gold at record levels for over 2 years now. China, Russia, India, Turkey, Poland, Singapore, the Czech Republic. According to the World Gold Council, central bank purchases exceeded 1,000 tons last year, the highest on record. And here is something most people do not realize. Central banks do not report their silver purchases. There is no official data, no quarterly reports, no transparency. But we can track the flows, we can see where the metal is moving, and the flows are all going in one direction, east. Shanghai silver premiums have been elevated for months. Before today's crash, the premium was around $9 an ounce. During the crash, it exploded to over $30. That is not a discount. That is desperation. That is urgency. That is someone who needs metal right now, regardless of cost. Someone in China needed physical silver so badly they were willing to pay a 30% premium over the spot price. Meanwhile, the paper price in New York was collapsing. Two different markets, two different realities, two different price discovery mechanisms. This is the fracture I have been talking about, and it has profound implications for what happens next. Let me give you some historical context because understanding the past is essential to understanding the present. In 1980, the Hunt brothers tried to corner the silver market. Nelson Bunker Hunt and William Herbert Hunt accumulated an estimated 100 million ounces of silver. Silver went from $6 to nearly $50 in a matter of months. The COMEX was facing a potential delivery failure. Then they changed the rules. They raised margins dramatically. They limited the number of contracts anyone could hold. They even allowed liquidation-only trading. Silver crashed from $50 to $10 in 2 months. The Hunt brothers went bankrupt. But here is the critical difference that everyone misses. In 1980, there was no shortage of silver. The Hunts were simply speculating. They were using leverage to manipulate the price. When the rules changed, the game was over. Today, we have an actual physical shortage. Demand is exceeding supply by 400 million ounces per year. China has locked down exports. Refineries are running at capacity and still cannot keep up. The margin hikes this time are not breaking a speculative bubble. They are creating an arbitrage opportunity. When paper silver is cheap and physical silver is scarce, what happens? Smart money buys the paper at a discount and takes delivery of the physical. That is exactly what has been happening at COMEX. Registered silver, the silver actually available for delivery, has been declining steadily for over 18 months. Every month, more contracts are standing for delivery. More metal is leaving the vaults. This is the opposite of what happened in 1980. This time, the shorts are in trouble, not the longs. And the CME knows it. That is why they keep raising margins. They are not protecting market integrity. They are protecting the shorts. Now let me show you what Kevin Warsh actually means for precious metals. The market sold off because Warsh is considered a hawk, a traditional central banker who believes in stable money. He's expected to keep interest rates higher for longer. But here is what the algorithms missed, what the headline scanners completely overlooked. Warsh is not going to be Fed chair until May at the earliest. He still has to be confirmed by the Senate. Several senators have already said they will oppose him until the investigation into Jerome Powell is resolved. That could take months, maybe longer. Senator Tom Tillis of North Carolina said he will oppose any Federal Reserve nominee until the Justice Department investigation is resolved. Without his vote, Warsh cannot be confirmed. Senator Elizabeth Warren called the nomination an attempt to seize control of the central bank. The confirmation process will be brutal. In the meantime, the current Fed policy remains in place. And what is that policy? The Fed cut rates 3 times in the second half of last year, 1.75 percentage points total. Inflation is still above their 2% target at 2.7%. The economy is slowing. They are trapped. If they cut more, inflation comes back. If they keep rates high, the debt spiral accelerates. There is no good option. The United States is paying over $1 trillion a year just in interest on the national debt. That number is growing by $1 trillion every 100 days. This is not sustainable. No empire in history has survived this level of debt, and gold and silver know it. That is why they have been rallying so hard, not because of speculation, Because of mathematics. When governments cannot pay their debts, they have two choices: default or devalue. The United States will never default. The dollar is the world reserve currency. They will simply print more. When currencies are devalued, hard assets rise. Gold and silver are the oldest form of hard assets. They have survived every currency collapse in human history. The Roman denarius, the Weimar mark, the Argentine peso, the Venezuelan bolivar, the Zimbabwe dollar. Every single fiat currency that has ever existed has either failed or been devalued. The dollar will not be the exception. The only question is timing. And today's crash does not change the fundamentals. If anything, it confirms them. The fact that China was willing to pay $30 more per ounce during a crash tells you everything you need to know. They are not selling, they are buying. They know what is coming. The question is, do you? Let me tell you what I think happens next. Gold will recover. It always does after these liquidation events. The 1980 crash was followed by a 20-year bear market because the fundamentals did not support higher prices. But the 2008 crash was followed by a run from $800 to $1,900 because of massive money printing. Today, we have the most money printing in history combined with the worst supply fundamentals in decades. The Federal Reserve balance sheet exploded from $4 trillion to $9 trillion during the pandemic. They have barely reduced it. The federal government is running $2 trillion deficits every year. Someone has to buy that debt. And increasingly, that someone is the Federal Reserve itself. They call it quantitative easing. I call it printing money. When you print money, the value of that money goes down. When the value of money goes down, the price of everything else goes up. Gold, silver, food, energy, real estate, everything measured in devaluing dollars goes up. This crash is a buying opportunity, not a top. Silver will be more volatile. It always is. The market is smaller, the swings are bigger, but the industrial demand is real. Solar panels need silver, electric vehicles need silver, artificial intelligence chips need silver. The International Energy Agency estimates that solar panel production alone will consume over 300 million ounces of silver per year by 2030. That is nearly 40% of total global mine production, just for solar. Add in electronics, EVs, medical devices, and industrial applications. There simply is not enough silver, and the deficit is getting worse every year. Mines take 7 to 10 years to develop. There's no quick fix. Every crash creates opportunities. The question is whether you're prepared to take advantage of them. If you want to stay ahead of these moves, you need to be here. I release analysis every week, sometimes every day when markets are moving like this. Subscribe. Hit the bell. Turn on all notifications. Because the next move could happen at any moment. Let me leave you with one final thought. $5.9 trillion disappeared in 30 minutes. And then, over the next few hours, $2.5 trillion came back. That tells you this was not a fundamental collapse. It was a forced liquidation. The machine needed to shake out the weak hands. The machine needed to reset the leverage. The machine needed fresh buyers. And now it has them. If you sold today, you were the weak hand. If you held or bought, you understand the game. The fundamentals have not changed. The deficit is still there. The shortage is still real. China is still buying. Central banks are still accumulating. The only thing that changed was the price. And lower prices with the same fundamentals means one thing. A bigger move is coming. The paper markets can be manipulated. The physical markets cannot. The divergence between Shanghai and COMEX today proves that beyond any doubt. At some point, the paper price will have to catch up to the physical price, or the paper market will simply become irrelevant. We are watching that process unfold in real time. Today was just another step in a much larger transition. Gold at 5,000, silver at 100 plus. These are not fantasy numbers anymore. They are the current reality. And despite today's crash, both metals are still up massively for the year. Gold is up 18% in January alone. Silver is up over 40%. One bad day does not change a bull market. It just shakes out the tourists, the people who were here for the quick flip, the weak hands, the real investors, the ones who understand what is happening. They are not selling, they are buying, because they know that the fundamentals have not changed. The debt is still there. The deficit is still there. The shortage is still real. And when you have more demand than supply, and you have currencies being devalued, and you have central banks accumulating, prices go higher, not in a straight line. Markets never move in a straight line, but over time. That is the pattern. That is what history shows us. Stay informed, stay prepared, stay rational when others are panicking, because panic creates opportunity. The opportunity that presented itself today will not last forever. The markets will recover. The question is whether you will be positioned when they do. I will see you in the next video with the latest developments. This is Silver Signal. Keep stacking.